3. Is anybody there? Hopefully somebody's there so we can get this thing moving. Dun, 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 dun. Da, 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 da. All right, everybody can hear me apparently, so let's move on to the video presentation. See how that works out. Technology. Dun, 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 dun. All right, looks like we are ready to go. Let's put that away. And let's got this stuff, which is doing what? Dun, 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 dun. Oil's up at 77.78. The NASDAQ is cranking 521 points. That should be about it though, because that's 2.5%. And indexes don't move more than it's 2.7%. Indexes don't generally move more than 2.5% in a day. That's a huge move for an index. And the S&P is up 1.6, and the Dow is up 0.76. Big resurgent led by good old NVIDIA, of course, the super stock. All right, what are we doing here? Do we need this? We don't need this. Not now. What did we want to talk about? Oh, look, there's a title, Earnings and the Fed Meeting. Well, those are good topics. All right, well, we don't worry about the Fed until 2, except we should get Warren ready for it. So let's see, Warren. Nope, you're not Warren. ChatGPT. Oh no, he's not here. Holy cow, no Warren. All right. Chat OpenAI. Yeah. Oh, there we are. What do you know? Warren 2 full session, technical analysis ahead of the Fed. That's a good place to start. Woohoo. That's a lot of data. Not only that, just started a new chat for Warren too. See, the problem is when you start a new chat, they don't really remember everything you've been talking about. And so you lose a lot of stuff, which is unfortunate. But otherwise, but the other, this guy, the one that says full session, very overloaded. And this is Warren 2. This is our 2.0 version of Warren. But anyway, all right, so what's that say? Google. FOMC, meetings, calendars, and information is what we want to be on. I don't know why we're here. Oh, here you go. All right, so the last meeting was in middle of June or early June, I guess. We had a statement, we had presentation materials, and we had minutes. Well, let's not kill him. I don't want to give him the presentation materials. Well, maybe I do. If I do that, I'm going to burn. See, that's the thing. You have to think about how much you can give him before he's going to burn out on information. You won't. I mean, he'll be able to take all this information, but if I give him all this information, then I have to. That burns the chat because then then he's going to be overloaded essentially, and he'll be weighted so heavily on Fed stuff that he won't really be able to have good conversations about other things. All right, so. Oh. Well, that's nice and short. Actually, it's kind of redundant with the minutes, isn't it? Yeah, that's true. Why does he need that if he's going to get the minutes? All right, minutes of the Fed open meeting. That was gigantic. Okay. So, new topic is good to say so he doesn't, again, when you say new topic, he knows that you don't want to talk about the stuff that you just talked about before. New topic, the FOMC will announce a decision today. I'm feeding you the last minutes so you can give us context for the new statement when it's released at 2 p.m. July 31, 2024. That is incredible. That is such a large amount of information I just pasted in there. Now he's going to probably try to summarize what he sees. All right, so the June minutes provide crucial insights into the Federal Reserve stance considering leading up to today's policy announcement. Here's the key takeaways. Economic activity continued to expand at a solid pace, supported by strong job gains. CPI, while lower, showed only modest improvement. Now inflation has gone back up since the last meeting. Inflation dynamics. The committee noted that inflation remained elevated with core PCE price inflation at 2.8%. Despite this, long-term inflation was well anchored, contributing to positive outlook for disinflation. Again, not really working the way they thought it would. Labor market conditions. Labor market conditions showed signs of easing tightness, not really happening. We had one good job report, one job report that showed a decline, but not even decline, showed a lower rate, but then we're back up again. And we got non-farm payrolls Friday. Labor market conditions showed signs of easing tightness with declining openings, lower rate, gradual increase in employment rate. However, wage growth still there, though slowing, remained above the consistent levels. Monetary policy stance. They maintained the stance, blah, blah, blah. Financial conditions. The market had to ease modestly, primarily due to higher equity prices, still high. Consensus at the Federal Reserve Fed funds rate peaked. However, nominal Treasury yields remain sensitive to incoming data, especially related to inflation, global developments. Internationally, ECB and BOC had rate cuts, but now the Bank of Japan raised rates today. So implication, given the June stance, it's likely the Fed will maintain the current range as inflation remains above target and they're waiting for more data. Market reaction. Markets are closely watching for signal. The June minutes highlighted the importance of incoming data, blah, blah, blah. Recent economic data, including today's employment cost index and tomorrow's report, will be crucial. The Fed will likely discuss these indications. The heightened geopolitical tensions in the Middle East and the impact on oil prices could be a factor in today's discussion. And the Fed will continue to emphasize clear communication. Analysis. The Fed's cautious approach to lowering rates reflects its commitment. The committee's observations about easing market tightness suggesting significant deterioration in labor conditions could prompt a more dovish stance. However, current strong job gains provide a buffer. Contrasting monetary policies of other central banks and their impact on the economy will be a consideration. The Fed will remain cautious, monitoring how these dynamics. The Fed's emphasis on maintaining financial stability, changing economic requires a careful balancing act. Okay. The Fed announcement is expected to maintain the current rate, strong emphasis on data dependence for future decisions. The Fed's cautious stance aimed at ensuring inflation returns to 2% market underscores the importance of upcoming economic data in shaping policy, geopolitical risks, and monetary policy. The policies will also play a crucial role, blah, blah, blah. Okay, great. So he is now ready to quickly analyze the new Fed minutes when they come out in an hour. So now we can move on from that. Oh, see, there's a whole nother Fed thing open. Okay, we don't need that. What else do we have? Oh, I made a note to myself. That's right. I just made a note to myself in PSW. We're going to talk about earnings. You know what? I'm going to finish it. Let's first things first. Let's finish up the watch list. Last time we were on the watch list, we left it off at, oh, it refreshed itself. No, oh, okay, we were up to Trox last time, and now it's finished. So let's go ahead and take a look at these new additions. Oh, come on. Ugh. Oh no, where's my watch list? Here we go. Excuse me, I have signed in. Thank you. That's interesting. All right, so now I forgot where we were. We were in the T's, I guess, right? RST. There we were, somewhere around there. Trucks. All right, so we got Trox. They make titanium dioxide, which is a nice specialty material. I like them a lot. Um, very, very cheap. In fact, we started at 1650. They're back to 1650 now. Trivago does not have options, but they're a nice little travel stock. We like them. Yeah, we started liking them at 166. Now they're 210. That's not really that much though. Travel stocks seem to be doing well. They're getting no respect. That's a good one. TWO pays a very nice dividend, which yielding 13%. So this is a fantastic one for an income type portfolio. Wow, look at UHS. What the hell? Oh, I wrote that. They just got away from us on earnings. Holy cow. Look at that. Look at that bump. Too bad we didn't get to that sooner, right? Here's Vail. Oh, now Vail had good earnings. I don't understand this. It's like they just reported nice earnings and the stock still is going nowhere. They're getting no respect because it's because of the lawsuit. They've got the overhang of this lawsuit. They had that dam broke years ago, and they caused a lot of damage. So they're in the courts. They're going to figure out a settlement eventually. And once that's done, they've already set aside money for it and all that. So once it's done, unless there's something drastically large about the settlement that's not apparent, they'll just get back to normal business again. So I like them. It's just this court case has to end. VTRS has been moving very well. VTRS they're a division of Pfizer that got spun out, and it's they make certain types of drugs called biosimilars, and it's a good division. They've got great revenue stream. Pfizer spun them out to get rid of some debt. So they basically the function of these guys is to milk these products and use the money to pay down the debt. But meanwhile, Pfizer itself was able to free up the debt immediately from PFE because they spun the debt out, and said, "Here you go. You're the division that pays off debt." Pfizer now looks like a much better buy because they don't have the debt anymore. It's saying they sent it out with these guys, but they didn't leave them in a position. It wasn't a scam. They didn't leave them in a position where they can't service their debt. And now that people are looking at their books, they're saying, oh yeah, this might work out. This could be actually a good little stock. Walgreens catching up a little bit, catching a little bit of a bid after earnings. Now here's the thing, bad earnings, still a long road ahead for guidance and all that, but meanwhile they bottomed out. So I'm sorry, I like them here. I think this is still a good spot. Whirlpool. Also, again, it's like just they're a market leader. We started like them 150, now they're 100. So I really like them down here. They just had bad earnings. They're having trouble. The global economy is slowing. People are not prioritizing buying washing machines and dryers, and the housing market is cratered. But with all that, people are still happy to pay $100 for them. Keep that in mind. So in other words, you got China slowed down, the whole world, 60% of the people in the world believe we're currently in a recession because their life sucks. Okay, so that's an important factor. As you know, people put off, you don't jump and buy a new washing machine if you don't have to, or a new dryer if you don't have money. I mean, honestly, unless people are scared of money, they generally never buy these things until they break. And these appliances last a very long time. And Then the other sales factor for these appliances is going to be new household formation. We don't have a lot of new household formation, and therefore it's just a very poor economic cycle right now for Whirlpool. But nonetheless, despite all that, the 85 was a very strong floor, and 100 seems to be holding up well. So they're a great value down here. We liked them at 150. I love them at 100. Yeah, right. They're trading 12 times forward earnings, and they're, it's Whirlpool. They're always going to be there. It's good to buy a stock that's always going to be there. They'll pay you dividends. You can sell calls against them. It's a great stock. Xerox, also super cheap. We started like them at 17. They're 11 now. And I remember we didn't buy them at 17. We never bought them. They weren't in our portfolio, but we've been waiting and waiting for a good bottom. I think this is starting to be a good bottom because revenues are down 10%. The EPS is 29, but you're only paying $10 for the stock. Let's say $11 for the stock. If they're making 29 in the quarter, and you multiply that by 4, that's $1.20 against an $11 price. It's a PE below 10. But they're not even saying this is a particularly bad quarter, and they're saying they're looking at like 6 times forward earnings. All right, so they're changing things around and doing stuff. They're not a copy machine company anymore. They do all sorts of other stuff, and they pay a 10% dividend when you own the stock. Keep that in mind. You look at Xerox, right? XRX. Oh, they only have short-term options. That's one reason we never bought them, because they're no fun. So anyway, so 1090. So you buy the stock for 1090. You sell the October. Oh, that's October next year. Well, it's almost 2 years. All right. So it's 443 days. Actually, it's a year and a bit. So you sell the October $10 calls for let's say 220. Okay. So it's 1090 minus 220. And then we say we're willing to buy twice as many. So we sell the same amount of calls for, let's call that 180. So minus 180. And that means our net is 690, and we promise to be called away at 10. So if we get called away at 10, we're going to make $3.10, which is almost 50% in just 400 days. We're going to make almost 50% in 400 days. And what's the worst case? If they're below 10, which is a 10% drop from here, if they're below 10, then we would get assigned another batch at $10, and we'd be at $16.90, right? So $10 plus $6.90, we'd be at $16.90, which is $8.45 per share. So the worst case is we own the stock at $8.45 per share. So if I'm willing to own 1,000 shares for $8,450, there's no reason not to do 500 of these spreads. And what's the spread? You buy the stock, you sell the $10 calls, you sell the $10 puts, you net in for $6.90. So if I'm willing to buy 1,000 shares, then I should start with the options, which is 500 shares. And if it works out, minus 1,000, so it's 3 and 10 plus 5. 1550. So if it works out, I would make 1550 on 690. On my net 690, I'm sorry, it's half of 690. So anyway, the potential profit is 1,550, and the price was 690 times 5, 34.50. So about 50%. So you buy the stock, sell the $10 puts, sell the $10 calls. Your net is 690, and you make you're going to make $345, $3,000. It's 50% in 400 and whatever days it is. So it's 365 plus not much plus 80. So a year and 3 months. That's easy, right? Plus you get the dividend. Oh yeah, we didn't even forget about that. Plus you're getting a 10% dividend while you wait. So, I mean, how much easier can it get? All you're doing is promising to buy Xerox for $8.50, which is 20% below the current price. So I promised to buy 1,000 shares of Xerox for $8.50, $8,500. And if I get to buy it, it'll be under 10. So whatever it is, as long as it's not 20% under 10, you're not losing any money. And if I don't get to buy it, if it's over 10, I'm going to make 50% on the $6,500 I'm laying out for the spread. Or whatever the amount is, 35, 30 something, whatever, 3,000 something. Not a very risky way to make that much money, is it? So this is what the usefulness of the watch list is. You see something like that and you say, hey, I can make a good play out of that. We should do that. Yeti, I love Yeti. What happened to Yeti is this, I forgot the name of them, this competing cooler came around. The one that was a fad for a while, the great big handle. It had a great big handle at the side of the cooler. That was their innovation compared to Yeti, which doesn't have a great big handle. But that great big handle is annoying. Also, those coolers seem to break very easily and wore out very quickly because they were very cheaply made. And that fad ended because it wasn't a really good cooler. It was cool looking, and that's the thing. See, Yeti built up this category for high-end coolers. And I mean, all sorts of cooling cups and so on and so forth. Where's Yeti? Yeti.com. Wetlands Connect. So they make, they start out as a camper cooler company, but these tumblers, that's what they're called, tumblers. This is my favorite thing. This is one of my favorite things on earth. Oh, and it's 38 bucks. It used to be 45. So highly recommend it, 38 bucks. They come in all kinds of colors. What color do I have? I have like a bluish sort of color. Where's mine? Oh, come on, man. Let me show off my color. That one. There you go. That's what I have. So I use this every day. It keeps hot things hot and cold things cold all for like 24 hours. If you put ice in there in the morning with your drink and you come back a day later, it's still got the ice and it's still ice cold. And I know, yeah, you say a lot of them do that, but it does it better. It never leaks. The seal doesn't break down. It's got a little magnet. This thing slides on a magnet, so it slides, clicks open and clicks closed, and it's nice because it works really well. It's actually better than lids and flippy things. And I see more and more people with them for coffee cups too. They make the coffee cup kind, not that, but like a sort of a roundy coffee cup. So anyway, apparently they've gotten their costs down, which is good. These coolers are like 300 bucks for a cooler, still very profitable. I don't know what that is. What's that, cookware now? Those things, that's the kind of people, a lot of people are getting these now and these coffee cup things. Oh, now they're making one with a handle. Look at that to compete with those other guys. But anyway, it's a great company, great expansion. They're moving into Europe. It's a fashion thing and a utility thing, and people like to have it in the office. And I'll tell you, I've had mine for a couple of years. It's not dirty at all. And if it was in my office, I'd be real happy with it. I mean, if I had an office I worked in. It's a good, durable thing and nice to have. You get your money's worth out of it for sure. So anyway, so that's why I like Yeti. I liked it because I was a client at first, and then I started checking out the stock, and the stock was a good value too if we look at the numbers on them. See, PE is 14.7 down here. Look at this growth. So 9, 10, 14, 16, 16.5, not much growth here, but don't think that was COVID. 18, and 19.5. So they're growing about 10% a year, a little bit better than 10% a year. More importantly, profits 50, 150, 200, COVID, 222, 246. Well, what else do you want? And so 246 into $3.4 billion is probably getting less than 14.7, and it's not like that. It's it's not like $2 billion is killing the camper market. By the way, again, AI. I see Yeti is doing almost $2 billion in sales. What is the total addressable space for them, and what kind of dollar growth can we expect to see? Also, if you can highlight some categories that should perform particularly well. So this is Bodhi's platform, which is called Perplexity. And he's really good at pulling up information and doing analysis and so on and so forth. So total addressable market, well, exact figure isn't provided. We can make some inferences. So he can't find an actual figure, but outdoor recreational products, vast, including coolers, drinkware, bags. The company's been expanding internationally, reaching 19% of sales in 2024. Yeti has recently made acquisitions to expand into new categories like high-end backpacks and cookware. Oh, see, that was cookware. I thought so. Considering, oh, shit, I'd look at that. Okay. Conservative estimate might put their TAM in the 10 to $15 billion range, but it could significantly larger given the potential expected dollar growth. Yeti's recent performance, 13% year over year for the full year. For the quarter they were at 341, right? They report 1.6 billion, a 3.98 increase from 2022. They maintain outlook. Conservative growth 5 to 10 pace, expected dollar range. In that, categories perform well. Drinkware sales grew 13%. Coolers grew 15%. International business grew 39% in Q4. Wow, that's really good. See, with 1,000 new stores carrying Yeti products. I mean, they hadn't been in international stores much, and this is a huge expansion for them. So basically, easily, they can double by adding international sales, probably more than double, because frankly, people in other countries are much more into backpacking and hiking and all that crap than we are. So significant room, blah blah blah. Well, you're not getting really good numbers, but he's basically saying they could go 10 times from where they are now. That's the key. So to me, it's a young, growing company. They've been making the right moves. They rode out COVID with style. So I like them a lot. Let's put it that. We'll leave it at that. I like them a lot. So I think this is a great company and a great time to get it. They're low in the channel. You're not going to really get a much better price than this. The recent earnings were good. The new earnings are coming up. So they are probably due for a nice breakout of this 42, of this descending channel. And once they get out of that channel, they can start really putting on some growth. Wait, why? I finished my watch list. Or was Yeti the last one on the watch list and I left the in progress? Maybe I left the in progress because we don't have any of these stocks, I don't think. Oh yeah, right. I left the in progress because now I got to go back and go for the new stuff that we want to add to the watch list. These are just the old watch list stocks that we kept. Now I got to figure out if we want to go back. So as earnings season goes on, because these are live charts, this is what we want to do. When we see something like that, because maybe BXMT had bad earnings or whatever, that's an opportunity, right? So we want to jump on things that when they change, if they change in our favor, we want to say, oh, I still like them, even though they had bad earnings, or even though they came down for whatever reason. That's a great way to look at it. Now, that brings me to today's post, because I love this tool. This is one of my new favorite sites. Find what I said. Here we go. Earnings Hub, that's what it is. So I like this a lot. Apparently if you hit the arrows, it goes to the different weeks. I didn't know that. All right. Create a free account. Continue with Google. I don't know. Must have signed up somehow or another. All right, that seems reasonable. So they are just filled with information. So here's a little news about stocks and things like that, which is kind of nice. But what I like the best about it is that when you do this, when you say, oh, what happened to MasterCard? Check it out. This is so well organized. So whatever you click on, it brings up all this stuff, and it's got price, news, price information, activity, you know, people buying insider trading and stuff like that. Whoops. Oh, there you go. So they show you the earnings. It takes them about a day to kind of get updated on the earnings usually, but so they had the expected, the reported, the beat, what they are, the actual earnings call, but not the transcript. I have an issue with that. They don't have the transcripts, just the call. And you can listen to it at high speed. And then it tells you when the next earnings call is, which is very useful. Previous earnings, you can see how they've been doing. Look at these guys. Freaking beat, 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 beat. That's a heck of a company, right? So this is very, very useful. It's a little too much information because you can kind of get lost in it. But I do love it. So I do love it, but if I stare at it for too long, I end up checking out I go down all sorts of rabbit holes. But it's earningshub.com, and I highly recommend it. There's a lot of cool stuff on this site. And it seems to be, I don't think I paid for it. I don't think so. I think this is just what you get for free. Who would we looking at? Marriott. Marriott was okay. What happened? The revenues missed. You know, but you know what? This is always the thing. When you look at when something misses, you got to look at how much it missed by. It missed by 10, you know, 0.5%. Earnings were up, but the revenues were a miss. And revenues are, you know, with a hotel thing, you don't blame them for the revenues, not necessarily their fault. Well, that's nice. AI earnings summary. Yeah, sometimes you see them, sometimes you don't. But then it has a full summary. Oh, look at that, right? Positives, negatives. It's really kind of nice. So I like that a lot. And you can see how uneven somebody is. And also, so here you go, like revenue missed by a bit, EPS missed in Q1. So they're coming off that. And now we take a look and see how they actually look. I like Marriott. Oop, get away. Nope, not MasterCard. All right, unfortunately, they're trading kind of high. You know, so 23x now. They're growth. They don't have that kind of growth. Marriott just absorbed who was it? Wyndham? I think they absorbed Wyndham and became by far. I think they're half the hotels on the planet now. So let's call it limited room for growth. And it basically means they're extremely economically dependent on travel and so on and so forth. But what I would say is next time there's a COVID-y sort of incident or something like that, this is something we really want to jump into because, you know, people are going to travel, people go back to traveling, you know, but they got cream. They went from 147 to 80. They dropped like 50%, 60 something. They dropped 50% on COVID, and COVID is resurging right now, and hopefully it shouldn't be as bad because we have a vaccine. See, before we didn't have a vaccine when we had it in 2020. So we didn't have a vaccine until what, 2020, almost 2022. I think it was at least a year and a half before they started rolling out vaccines. So it spread. There was nothing you could do about it. It was really bad. So now most of the world has been vaccinated, which creates a herd immunity, a firewall of sorts against a massive spread again. And also we've all been exposed to it pretty much. Very few people haven't been exposed to COVID at all. So there's a great degree of resistance, and it's more likely that if it goes and spreads again, even if it's a bad strain, a bad flu, basically, it's like a bad flu. If it's a bad flu season or a bad COVID season, and it spreads again, most likely it'll be just like a bad flu season. There'll be more deaths because it will kill more. It's 10 times more virulent than a regular flu virus. So if you get it and you're old and you're sick, it's not like the flu, it's like you die. It's a lot worse. So it's a lot better at wiping out senior citizens, put it that way. And obviously people who are sick, people who have lung issues or whatever, those people are in very, very high risk. It's very dangerous, and it's a shame. But for the bulk of the population, we'll learn to live with it, much like we learned to live with the Spanish flu, which eventually became the flu, and nobody cared anymore. You know, everybody got it. Almost everybody in the world was exposed to it, got it. Huge amounts of people died. Tens, hundreds of millions of people died from the Spanish flu. But it was in 1920 or somewhere around there, 1920s. And it was horrifying, but once everybody gets something, we tend to move along. You know, it's just unfortunately in the early stages. So now, especially since everybody who gets, you know, if it starts getting really bad, people can run out and get a vaccine. I haven't gotten a shot since I think November. I don't think I've gotten a booster shot since November, so I should really go back and get one myself. So anyway, so the factors are different. So it's not likely they're going to get shut down, but you could still have a big sweep of COVID that makes people paranoid and drops their stock 20% or whatever, and that's what we're looking for. You know, I don't want to say it'd be nice if that happens, but if something bad happens, that's when we get it. Same thing with Boeing. Well, that didn't work, right? But the same strategies with Boeing is that we don't buy them unless something bad happens. And when something bad happens, they're usually going to move on. That has not been the case. But that's because so in other words, if there's a plane crash, they're going to come back. But in this case, the plane crash was due to not some random event, but the fact that they seem to have lost control of their quality. So they went down and down and down, but then they're forming a base here. I remember we did something. Maybe we just sold puts. I don't know what we did. I know we have a Boeing position now that we didn't have before because we did decide that this is forming a good base. And look at that. And I mean, but they got a new CEO now, and they're turning things around and focusing on quality. I hope it works. But they can't really afford much more screw ups. Look how bad this has been for them. So they got hit with COVID, 11 billion lost, 4 billion lost, 5 billion lost, 2 billion lost, 2 billion lost. Next year, they'll make $4 billion, and the market cap is 115. Even if they make $4 billion next year, that's not that great, but they're capable of making $10 billion. So if they can get their shit together and make $10 billion a year again, this becomes a reasonable price. And so we were kind of, we started betting that would happen, but they don't make it easy. Boeing does not make it easy for you to bet on them, that's for sure. Let's see. We're back to my toy. Where's my toy? I lost it. God damn. Oh, nope. Nope. What did I do with the thing? Oh, there it is. Oh, that's why I didn't think I put it way over there. Anyway, so very, very useful. And, you can look, see what's predicted for people. Oh, I get it. Okay, I think post earnings. No, it's not consistent. I guess it's probably for bigger companies. Wingstop, is Wingstop big enough to get a report? Nope. GE Healthcare? Yes, the GE Healthcare gets a summary. DuPont gets a summary. Wingstop does not get a summary. So I imagine they must have some criteria of whether somebody's worth giving a summary or not. Hess doesn't get a summary. Marriott we saw got a summary. I don't know what their criteria is for giving somebody a summary, but anyway, so apparently after earnings, somebody will give you a summary of what happened if it's a important enough company. So we got Meta. We have Qualcomm, who I just talked about. I think they're a good value. In fact, I would almost play these guys ahead of earnings, but their PE is too high. It's annoying you have to go to different places to get information. Who is XUCom? We just talked about them in member chat. Oh, no, they're not. What did I say about Qualcomm this morning then? Certainly 15 times is not too high. La da da. Control F. QCOM. Earnings this evening seems cheap. So what was my oh yeah, so I was thinking they look good, and so I wrote that. Then I had Bodie take a look at it and give me a real analysis, and he said that they're trading at 15.5, blah blah blah. But anyway, so his pluses and minuses are that they have near-term challenges. They are, for the long term, they're certainly good. So this is exactly the kind of stock that's like I'm talking about. We hope they miss. That was my conclusion here. It's like, hopefully they miss and we can jump in and buy it. Because it's like, I'd like to buy them at 15 times earnings. I think it's possible that it's maybe 60% that they beat and 40% that they miss. But if they miss, it would be such a great opportunity. I almost don't want to buy it ahead of earnings because we hope they miss. Then we can really deploy some capital. So if they miss, we'll certainly jump in. And if they don't miss, then we'll take a look at it and see how good they're doing and decide if we want to take a position. We're not precluded from taking a position if they don't miss, but it's just not a sure thing enough where I want to jump in before earnings. It's not worth it. So we're going to wait and see what actually happens. That's where we ended up with Qualcomm. So definitely, if they miss, absolutely we want them. Unless the reason that they miss is something catastrophic. But from what we see of the company, they should have some still near-term challenges, which the market is not very happy about right now. Should be some near-term challenges because they have to rejigger their chips and move towards a more AI direction, just like the other chip companies have to. Costs a lot of money, and the market has not been very patient or forgiving about these things. So long-term, though, strategy-wise, Internet of Things-wise, robots-wise, Qualcomm is hugely important because all these new intelligent devices, all these AI devices, AI robots, things that you're going to get in your house, things that you're going to get in your car, so on and so forth. They have to be driven by the 5G and eventual 6G technology that Qualcomm excels in. That's their thing. So you got to communicate with these things, and that's what Qualcomm does. So absolutely, I want to be involved in Qualcomm. Aflac insurance companies are tricky because my interest rates, look at their revenue here, 26% beat last time. I mean, people were really underestimating these guys. Okay. So they're trading at 14x. They were very, very underestimated in the last earnings, but now they've gone up quite a bit from there. So they're up 10% from last earnings. But they were underestimated by 26%. So this is not reflecting how much they beat by. Climate change is causing a huge amount of increased claims. It's tricky to say whether or not it's hitting them hard. And this is another one where if they get a big hit, I kind of am inclined to buy because the rates are going to stay high for a long time. Even if the Fed eases a quarter point, which they're not going to at this meeting, but if they do a quarter point in September and a quarter point in September, October, November, yeah, it'd be a quarter point in September, a quarter point in November. Even if they do that, that's only a half point down. Then next year, they're not going to do half their meetings are going to be a cut. So, you're only going to be down to 1.5% over 2 years. That's still going to be huge amounts of money for Aflac because insurance companies are forced to conservatively invest their reserves. And so they're very rate dependent. The higher the rate, the more money they make. So as long as they don't take a huge hit, and also there's a trend that the states are approving more and more insurance rate increases because the insurance companies call their bluff. Like states that wouldn't approve increases in coverage, like Florida and California didn't give them the ability to raise the rates as much as they wanted to, and the states thought they could play hardball with the insurance companies, but the insurance companies pulled their bluff and said, "We're out of here. We're out of California. We're out of Florida. We're not insuring this bullshit anymore. No more property insurance for you guys. It's too dangerous for the insurance companies." So therefore, California is obviously a gigantic state. But even a huge state like California, the insurance company, like, you're not a profitable state, so we're not going to insure here. You're going to have to let us bump rates 15, 20% for us to come back. And the states are buckling because they can't afford to insure it. And that's what's happening in Florida. Florida, the state has an insurance fund that is the property insurer of last resort. So, now that fund has nowhere near the adequate coverage to take care of all the people who signed up for the policies. They need private insurance to pick up the slack. And and the private insurance companies are being like, "No, we're not coming back here. It's a terrible state." And we'll see how this hurricane season goes. Everybody's dreading this hurricane season. They say it's going to be like a record. And the National Weather Service now has has increased to a Category 6. Used to be only Category 5, which went up to 180 miles an hour. Now they have 200 mile an hour Category 6 hurricanes. That's terrifying because the codes only allowed for a category, the building codes only forced you to build up to a Category 5 at 180. So if you get hit with a 6 and the building isn't built to take a 6, you could lose a lot of stuff. Like you can have skyscrapers like falling down. It was not a good situation, frankly. So we'll see what happens. Everybody go see Twisters. That's supposed to be very good, give you a good idea what's going to happen. All right, so that's them. I like Aflac. Allstate, obviously, same situation, although I like Aflac better. It's my favorite. Allstate, I like Aflac and I like Allstate. Those are my two favorites. MGM, too much China exposure. I worry about them and what their numbers are going to look like. This is Coca-Cola bottling, not Coke. Etsy, yeah, that's not my kind of thing. Transocean, we just picked a play on Transocean, didn't we? Where was that? Oh, that goes back to here. Boy, we've been busy today. RIG, I know I said that 13 times. Here it is. So what I like about RIG is when it's at 578, it's fun to play stocks like this because you can get really cool little option plays. So for Transocean, we went with 50 of the December $3 calls. We sold 30 of the January 2026. So there's a year spread on this. 30 of the January 26 $7 calls. Again, I'm taking advantage. It's a small price stock, so we're not killing ourselves with this layout. We sold the puts, 40 puts. And so if we sold 40 puts at $5, ignore the spread. But if we sell 40 puts at $5 and we're paying $385 net, all right, and the stock is at 578. So 578 minus 385 is 193 divided by 578, 33% discount. So with these puts, the worst thing that can happen is we get a 33% discount at, what was the price? I forgot. It was anyway. So it's 385. So the worst case scenario is we own the stock at 385. The stock has not gone to 385. At 450 was bouncy back in February. 385 is like way down here. That's our worst case selling the put. So that is free money. We're happy to buy RIG. Oh, what the frick is that? Oh, open up a new thing. We're happy to buy RIG for $5. That's our obligation, right? We're happy to buy them for $5. 40 contracts, $5, 4,000 shares, $20,000. That's our risk. We could end up owning $20,000 worth of RIG at $5. $5 is more than 10% below the current price. Worst case scenario. We're going to buy though 50, so we're buying 50 of these spreads. We're selling the 30 of the January calls and 20 of the November calls. The November calls are 100 and something days out, 107 days out, and we've got 870 days to sell. So even after this, we're going to have 7 more times that we can make these sales. 7 times 1,200 is 8,400. So we can sell $8,400. So the net of the spread is $8,600. We can sell $8,400 worth of short calls, plus the spread is a $20,000 spread. So we could make $11,400 there and sell $8,400 there. That's $18,000 against the 86. That's more than 200%. That's a nice little trade. And that was driven because there was news that they got a $500 million drill ship contract. So for 3 years, one of its ultra deep water ones are going to be rented out by BP. This is a sign that the big oil companies are coming back and finding profits drilling in the Gulf of Mexico. So Transocean has, oh, here's a fleet status report. They have 600 million in backlog with their fixtures. And so what I said is at this point now, so now they got a 600 million backlog, $500 million there. They have a huge amount of rigs that have been mothballed because it's been many years. It's since COVID. They've had a huge amount of oil rigs that they own, perfectly functional rigs, because they tow them from place to place. They float. So they have them in mothballs, basically, like in storage, that they haven't been using for a very long time. So this backlog and this rental from BP means they can start pulling these rigs out of storage, and that's like found money because it's a non-producing asset that they are now going to ship out to wherever and start producing money, and it's going to start flowing in. Then, of course, you want to say, well, how much of an impact is that going to have on a stock like RIG? Well, it's not that big of a stock, really. It's only a $4.5 billion company with only $3 billion in sales. So at the trend they're at now, they see it ramping up to $4 billion in sales. 4 billion sales is where they turn a very quick profit. So this is break even, it's 3.5. And as you can see, they go to 4. It's practically almost every penny now from here on in goes to profit. So by 2026, they could be making $500 million a year against this $4.6 billion valuation. So that means less than 10x earnings, currently showing at 34. So now is the time to start getting in on this stuff. But the strategy we set up was very conservative. We only set a price target of 7, and it's at 580 now. And we're going to plan to make a huge portion of our money is going to be made just selling calls, selling completely covered calls. So we don't really have a lot of risk here. The only risk we have is if they plunge much lower than we think, but we super duper do not think that they are going to go back to, well, look where they went back in COVID. They were down to $1. So that's the risk, but again, it's not very likely, and we think that it's still a good value. You know, we haven't, you know, we still are drilling for oil. America is making 13.5 million barrels a day of oil is being produced in America now. That's almost all we use. Oh no, the Fed came out. Fed continues. Job gains have moderated. Oh, well, screw that. Let Warren tell us. All right. Anyone got comments? Bernie says, why don't you think the Fed will lower rates in September? Isn't this the last chance prior to the election? Yeah, it is, but that they shouldn't care about that. And also, what was I going to say? It's the data's not there. If they claim to be data dependent, if they're going to be data dependent, there's certainly not enough data to say that you should be lowering rates. All right, so here we are, July. Open a new window. Okay, so. So now I go to Warren and I say, here is the new Fed announcement. First, tell us what words have changed since the last announcement and what those changes mean. Fed job gains moderated. I'm just reading off of CNBC. All right, economic activity in June and job gains. They had said job gains remain strong and the unemployment rate remain low. Now they say job gains have moderated and the unemployment rate has moved up but remains low. The Fed acknowledges a cooling in job gains and a slight increase in the unemployment rate, indicating a softening labor market. Inflation has eased over the past year but remains elevated. Inflation has eased over the past year but remains somewhat. So they added the word somewhat. The additional word somewhat suggests slight improvement in the inflation outlook, but is still above target. Progress, see, Bern, that's what I'm talking about. Progress towards inflation objective. In recent months, there was modest further progress towards the committee's 2% inflation. In recent months, there's been some further progress. So there was modest, and now it's some further progress towards the committee's objective. So they are saying they're moving in the right direction. Slightly more optimistic view. Risk to employment and inflation goals. Committee judges the risk to achieving employment and inflation have moved towards better balance. The committee judges that risk to achieving employment and inflation goals continue to move toward better balance. It's so funny. It's like such a silly thing. The continued movement towards better balance is just ongoing improvement. Dual mandate. Committee remains highly attentive. The committee is attentive, to risks to both sides of its dual mandate. The emphasis has shifted from a singular focus on inflation risk to a balanced attention to both employment and inflation risks. Committee composition, voting members list. Austin Goolby, voters in the okay. Slight change in composition of members, which might reflect internal adjustments or scheduling. Yeah, you don't know what that is. Oh, he analyzed it even though I didn't ask him to. Okay. The acknowledgement that job gains moderated and not unemployment rate has moved up, albeit remaining low, points to a cooling labor market. This moderation is likely the result of the Fed's previous rate hikes. Inflation outlook, the shift in language from elevated to somewhat elevated suggests while inflation remains above, there's perceptible improvement. The change indicates cautious optimism. The continued movement towards better balance in achieving employment and inflation goals suggests that the Fed believes its dual mandate is becoming more aligned. The Fed's decision to maintain the current range, coupled with data, underscores its cautious stance. The emphasis on market economics. The language changes signal to the market that the Fed is seeing incremental improvements. Closely monitoring labor, the balanced view may help anchor market expectations, reduce the continued reduction of the Fed's holdings of treasuries and debt, includes a commitment to tightening financial conditions gradually. Today's Fed announcement, nuanced approach to language adjustments. Just while the Fed sees some improvement, it remains committed to a data-driven strategy, has not yet ready to signal a shift towards rate cuts. So technically disappointing. Investors should interpret this as a sign that the Fed will continue to monitor blah, 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 blah. Okay, great. Let's make members see that. Control B. There we go. Control B. And post it. All right, that's where we're at. And what is the market reaction? Don't ever set these charts up, did I? Damn it. Active trader, and I guess this should be RTY. All right, so Russell not particularly happy with it. Look at that volume surge. Russell not particularly happy about it. Nobody's really happy about it. Just sort of flattish though. So it didn't kill the Nasdaq, still up 500 points. So now it's going to depend on what Powell has to say in 20 minutes. But really, not much of a reaction at all. Let's see what Warren thinks. So overall, how likely do you think it is that the Fed will cut rates at their September meeting? See that? Relatively low. I agree with that. Here are the key reasons. Fed noted job gains have moderated and the unemployment rate has not moved up, but remains low. This indicates softening labor market, which could potentially reduce inflationary pressures. The Fed would likely want to see more consistent data to confirm this trend is sustainable before putting in job cuts. rate cuts. The statement mentioned that inflation has eased but remains somewhat elevated. Language shift from elevated to somewhat elevated indicates cautious optimism, but suggests inflation is not yet at a level that would justify a rate cut. The Fed's emphasis on needing greater confidence that inflation is moving sustainably towards a 2% target, that's a big deal. We're not showing that we're moving to the 2% market, let alone sustainably. And sustainably takes more than 3 months to have a trend. Balance of risk. The Fed acknowledged that the risk to achieving the unemployment inflation goals continue to move into better balance. The balance indicates the Fed is seeing progress but remains vigilant. The Fed's commitment to a data-dependent approach implies that future policy decisions will be heavily influenced by upcoming economic data. While there may have been some positive signs, the Fed will likely need to see more robust and consistent evidence. So now there's a lot of weight on the jobs report that's coming up, and also productivity. If we're not seeing productivity gains that balance out the higher wages, there's no way the Fed wants to ease. Geopolitical tensions and their impact on oil prices, as well as the global economic developments, are factors that could influence the Fed's decisions. Elevated oil prices could lead to higher inflation, while the global economic slowdown could impact the economic activity. Historical precedents. The Fed tends to move cautiously, blah, blah, blah. Okay, so there you go. Let's throw that on there too for the chat members. Here we go. What does Fantelli say?
Here, take a step back. Look at the size of these refundings. 125 billion for 3s, 10s, and 30s. That is so much larger than it was just several years ago. And why were they allowed to create such huge deficits? Because the Fed rates too low, too long. They can't make the mistake again of being an enabler. We still have an administration that loves to overspend. They need to keep these rates higher for longer. One rate cut won't be a big deal, but they're going to trap themselves. The market says SEP. They're right in tune with the market. I hear people say 50-50. It certainly doesn't look 50-50 to me. But what is going to be a problem is how they set the stage after the first rate cut, because give an inch, give up to the elbow. They're going to want the whole thing. They're going to want more rate cuts. And the Fed really needs to be cognizant of the fact that we are now potentially looking at a Minsky moment when it comes to supply, and they're at the epicenter of how we frame the equation for how much we can spend, how much we can borrow, and how much we can afford to service the debt. Tyler, back to you.
All right. So I assume you could see that. So he's concerned, as I'm concerned, that the Fed can't just willy-nilly cut rates because we're so massively in debt. We have to attract. See, the Fed only has power because you think it has power. The reality is, though, the United States, as he just said, in 1 week, we're borrowing $125 billion to sell some bonds. We are literally borrowing $600 billion a month or something like that between rollovers and new debt. We're at $600 billion per month. That's $7.2 trillion a year of note rollovers and additional borrowings. 2 trillion of it is debt that we're adding to our national debt, which is already $35 trillion. So you have to get people to invest. So the Fed is tapering their own purchasing of our bonds, and they have to because their balance sheet's out of control. And that means that we have to attract other people to buy our bonds. Now, how do you attract people to buy bonds? There's only one lever you use when you want to have a bond auction, that's interest. And if you do not offer an adequate rate of interest where people feel the risk of investing their money long-term in dollar bills is going to be rewarded enough to keep up with inflation, etc., then they're not going to buy them. It's flat out. Why would you do that? So the problem is the Fed can't just say whatever they want and expect to get the dollars for it. Once they go, see, if they're in an unrealistic level, people won't buy dollars, and that will mean the Fed loses their authority. Everybody's gonna say, well, the Fed's not controlling shit then. because the Fed has backed themselves into a corner, which is exactly what Rick just said, actually. He said the Fed backed themselves into a corner because now they're tapering their bond purchases, they're trying to reduce their balance sheet, and if that means that they can't be the buyer of last resort on the notes. Therefore, you have to set the auction at a free market value, and unfortunately, dropping rates 1% from here is not going to be a free market value. We will not get people bought, and we will have failed note auctions, and then everything collapses, and we're Greece. And we are Greece. I mean, you can't kid yourself. We're $35 trillion in debt. We are Greece. The only thing is Japan is $15 trillion in debt, and that's 3 times their entire GDP. That would be like us being $75 trillion in debt. So compared to Japan, we look pretty good. But we're not. It just means we both suck. It doesn't mean that neither one of us is good. We just look better than Japan. So as long as we stand next to Japan, we look okay. But Japan's economy is 1/4 our size, not even 20. Their economy is 20% of our size, maybe even less, because their economy keeps shrinking. And that's the other thing about U.S. debt is it's one thing for Japan. I've said this for a decade now. I've said this since the 2008 crisis. It is one, and that's when Japan only had 200% of their GDP in debt. It is one thing for Japan to offer subpar interest rates and to sell their debt. Why? Because they only need to sell, between rollover and whatever, let's say 15 trillion. They only need to sell maybe $4 trillion a year worth of debt. No, it can't even be that, right? Because if we're selling 7.2, they'd be selling about 3 trillion a year worth of debt. Is that right? Yeah, not even. So they're selling 2 to 3, all right, whatever, $2 to $3 trillion. So they're rolling over $2 to $3 trillion worth of debt because their economy is 1/5 the size of us. That's the problem, though. We need all the money in the world to sustain our debt, just to roll it over. And if, God forbid, if somehow or other China or well, not Russia, it would have to be China. I mean, somehow China, India, or some other currencies start gathering more attention than ours, and they start growing, and India's economy is growing really fast. If they start growing their economies and they take more people invest their money that way instead of this way, then the only thing we can do is offer more interest to get people in. That's the future. It's going to happen. At some point, we're going to start losing that race. Right now, we seem okay, and that's because people prefer US dollar debt. But the way we're going, and when you have especially when you have a completely uncertain political situation every 4 years, other countries don't have this problem. We have every 4 years, you have no freaking idea what the Constitution is going to be like. The whole reason America became a superpower economically is because of the system of laws and the steadiness of the laws that we had in this country, and that you could count on policies to be maintained for decades. So you felt safe investing here and coming over here and so on and so forth. Now it's a wild card. You have one administration comes in, and 4 years later, another administration comes in and reverses everything the other administration did. And the Supreme Court is basically just declaring which bits of the Constitution they want to follow. They're just arbitrarily enforcing stuff. That's the opposite of why people invest in America. And the more we do this, the lower our status becomes, and people are going to stop looking to us as the safest place in the world to put money. Not to mention we have banking crises every 5 or 10 years. We have another banking crisis, so that's a whole other reason not to invest here. So let's see, how's oil doing? Oof, wow. Oil is up 8%. Dow 41,000, S&P 5,500, all looking good. NASDAQ is up 425, now pulled back a little bit, but we knew that would happen. That's no big deal. Oh, so that is where things stand. Take a beat. Anybody got questions? Let's see if we got questions or statements. Nope, nobody has any extra questions. Bernie said Apple 123 for some reason. I'm not sure what that means. Anyway, hang on a second. I just need a minute to not talk. Get my throat back together. Got another because we got Bernanke. Got Powell coming up. Things always in the way. Powell live stream. Fed live video. Federal Reserve. When is Powell's speech? How to watch. Nobody live streams it? Wow. They live stream so much stuff and they don't live stream this. Watch Powell, Lagarde speak. No, that's not it. Barron says you can watch it here. When is the speech? Live stream begins in 4 minutes. What? Oh, I guess it's some preamble. Yeah, but don't we know what these remarks are? My friends at the Journal, I think they would know. They love Powell. They worship him. Clears up. So that's good. Let's see how it's being interpreted. Despite what he said, we still have to get this interpreted. So we've been flat since God knows when this is. This chart doesn't seem to really have any particular use. So it's a chart, and when you do this, it makes a dot, but the dot doesn't tell you anything. Live update, how markets are reacting. Bank of Japan raises rates. No immediate retaliation on that Israeli thing. That's interesting. Okay. Federal Reserve, central banks, live updates. Oh, same stream. Oh, the Wall Street Journal is Barron's. That's why. It's the same people. All right. Powell scheduled to speak. Fed rate decision, what to know. Watch these 3 things at the Fed meeting. Options traders expect market fireworks after the Fed. Nope. I would have thought that his whatever his statement is prepared, but I guess not. So we will wait and we will see what happens. Well, we don't need you because we already got the other one. Right? Yep, there it is. So the Wall Street Journal really has no information. Because I tell you, Warren should run this shit. He's got way better commentary than they do. Let's see what this article says. That's not a good picture. I wouldn't be pleased with that. Federal Reserve officials hinted that they were moving closer. See, this is a weird interpretation, the spin. It's not interpretation, it's spin. Officials made 2 important changes to their statement. Inflation somewhat elevated. They underscored that this process meant that treat both sides of their mandate. See, it's just a question of emphasizing different things to steer the way you want it. The economy's been sturdy. In addition, recent earnings reports suggest corporate America is enjoying less pricing power. Consumers tighten their belts. I'm not really seeing that. I'm sorry. I was a big advocate of this. This was my premise going into earnings seasons, but I'm seeing a lot less consumer tightening than I thought. I can't believe how travel and leisure is still like doing so well. you know, McDonald's says, oh, it's this and that, but I mean, honestly, perhaps it's just what you're offering. So you have to look at where the money's moving to. Some of these, but again, it's also because it may also be because the top 20%, 18%, as we discussed last week, the top 18% have, you know, comparatively infinite money. I mean, they're just so much richer than the rest of the population. They go out every night, you know, so that's why some of the high-end guys are doing better. So people are not going to McDonald's. The people who feel like they're broke are not going to McDonald's, and that's true. It's hurting McDonald's, but other places like Cheesecake Factory and things like that, they're doing great because they're full every night because, you know, this is my suburbs. Like when, you know, my suburbs and my kids and their friends, they pick up they're at the Cheesecake Factory with my money. So so everybody's eating out and having fun in the top 20%. There are 1.2 job openings for every unemployed worker in June. Down. See, that's not really true either. There's a lot of openings, but they're not matching up with the employees that they're trying to hire. It's taking workers longer to find jobs. So there's a mismatch because there's lots of job openings, but for things that we don't have, like with tech skills and so on and so forth. So we've run out of people who have the skills needed to fill the jobs. So it doesn't mean that, and that's a very misrepresented number, because when you say something like that, you act like these jobs should be filled, and the only reason the people aren't filling them is because they're lazy. That's not true. These people won't hire. You know, Jackie graduated Stevens Institute of Technology. It's a good school, and she's been sending out resumes, or, you know, she graduated in May and it's July, and she's sent out 100 different resumes to people, and she hasn't gotten an acceptance yet. You know, I mean, that's not an easy job market, because it all comes down to the same thing. They want people who already have experience, and so yeah, the job is open, but they can't find anybody who fits the qualifications. Now, at some point, they're going to have to get realistic and say, okay, we're going to, you know, we will take college students and train them in their, you know, in a first job situation. But the problem is there's no training people. These companies, everybody's running so lean, there's no people to do the training. So even if you say, oh, you've got to hire these college kids through the class, you know, you got to hire the class of 2024. But the problem is they don't have anybody to train the class of 2024 because they don't have any extra people. The guy who would have been hanging around who could do some training is busy working. So there's mismatches, and they're not going to fix that easy. And so that, you know, so these jobs, these 1.2 jobs for every unemployed person, are not necessarily going to get filled because those people do not have the requirements of those jobs. And that means the people who are sitting there unemployed continue to be unemployed for very long periods of time. Mortgage rates, boy, they're all over the place with this stuff. Introduction. Democrats are seeking to retain control. Wow, this is a very far-swinging article with very few actual facts. Just kind of all over the place. And that's the Wall Street Journal front page. It's like, wow. What else is going on? Anything exciting? So Boeing has a new CEO, so we'll see what happens, but that means he's going to kitchen sink the next quarter. So, oh, what? It's Powell.
Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce.
Can you guys see this? Sure you can, right?
We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic. Strong, but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation.
See, that's a very key thing.
Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves,
don't forget Trump threatened him not to lower rates.
Maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping the longer-term inflation
So
expectations.
there's 2 more meetings after September.
Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals.
So the next meeting is right after the election, and Trump told Powell, essentially, if he lowers rates, he will be fired. If he doesn't lower rates, he can stay on as chairman. So basically, for Powell to lower rates in September without significant data that shows that he should, he's almost certainly going to be getting himself out of a job. Keep that in mind. And that means, who's he talking to here?
Matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, the Q&A moves the market more than the statement.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make a move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, it will be data dependent, but not data point dependent. So it will not be a question of responding specifically to 1 or 2 data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting.
Could be on the table as soon as, if the data is met.
Just say,
that's not a rate cut.
The sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point.
We're not there yet. Let's see how the market can be like.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So
nope.
I guess I would think about it this way. I'll give you an example of cases in which it would be appropriate to cut, and maybe it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly, or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier.
If all that happens, then a rate cut could be on the
We
table.
would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question.
That's a good question.
Data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all 3 categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy. I wouldn't want to lay out.
Wow, can you be more vague?
I said what I can say about September and about today, though.
Nick Timmeros, the Wall Street Journal. Chair Powell, you said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have 2 mandates, as you know. Labor market, maximum employment is one, stable prices is another. So we weigh those 2 things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic.
So that's going to be key on Friday.
Wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think inflation was actually core.
Ooh, that's a good idea. We should look back and see what he says they were happy with.
Labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're more confident that we're on a sustainable.
So they want 4.1% unemployment. They want 170,000 jobs a month to be about the right level for labor.
Chris Rugaber, Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent, if you saw risks of an unexpected cooling? Is that something you would cut ahead of time?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this, and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of, I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these 2 risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those 2 things. That's the nature of having 2 mandates. And I think this is how we balance them. It's a rough balance, but it does feel like, again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low. And we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low, so it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as yeah.
All right, so we get the idea. So it's going to be very dependent on the upcoming data. And with briefing, do I have briefing? Blah, 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 blah. Shoot. Okay. We don't need you guys. You seem useless. BRIEF, briefing.com. I'm not a robot. What? Go away. All right, so data. Economic. Page options. Oh, good. You can go to forward weeks here. Okay, good. All right, so what's coming up? We have an issue. We have the weekly thing, which is meaningless tomorrow. We have productivity is critical tomorrow. So based on what he's saying, right, this is what we care about. Productivity, unit labor cost is critical. They were 4%, then they're 2% last time. Oh no, I'm sorry. They were 4%. For some reason, people think it's going to drop to 2% from 4%. That's kind of insane, right? And productivity is supposed to go up 10 times from 0.2% to 2%, 10 times better than last month. So here's what is expected, that we're going to have 10 times better productivity, and we are going to have 50% less unit labor costs, which of course would be caused by the 10 times productivity. And that's all going to happen tomorrow, and magical fairies are going to come out of our butts and all that stuff. The ISM has been terrible, and it's expected to be just as terrible. Non-farm payrolls, this is key. They were 200,000. They're expected to drop to 160, which is significant. It's 30% less jobs than the last month, but that's not really likely to happen. If it does happen, it means we are dropping precipitously, and maybe the Fed should be on the table. Here's hourly earnings. It's supposed to drop from 3% to 2%, 0.2 to 0.3 to 0.2. The unemployment rate, they expect to be ticking up. The average work week steady, and factory orders are supposed to magically go up from 0.5 to +4. So that's a huge flip in factory orders. There's a lot of stuff here that's expected to be incredible changes that are all going in the Fed's direction. But what if they're wrong, as they are essentially almost always wrong? Wow. What a low data week. Wow, that's so interesting. I wonder if that's just that their advanced things don't show a lot of stuff. No, that's not the case over here. For whatever reason, the first week of August is like weird. So all we have there is ISM, consumer credit. That's not even worth being here for that week for data. Then we have in mid-August PPI, CPI, retail sales. This is going to be a big week. Housing starts, so on and so forth. That's a big week. Look, we're barreling towards the September thing. Then we've got leading indicators, initial claims. Then we've got, when's that next meeting? September 17th, right? Yeah. So, and then at the end of August, we've got durable goods. So these are the data points that they've got to make their decisions based on. Here's PCE, personal income, so on and so forth. And then we don't know what happens in September. So isn't that interesting? So basically, those are the data points between now and the next meeting. So how much data is he really going to have to make a decision? There's a lot of weight on the data we have here. because that's a bulk of the data. Then they're going to get another round of non-farm payrolls and productivity. No, they won't get productivity because that's quarterly. So they're going to get, in early September, they're going to get another shot at payrolls. They're going to get another shot at factory orders, construction spending. They'll see no, they won't get a productivity report. This productivity report is huge because they're not going to get another one. There's a huge amount of weight to be put on this. We got to talk about that tomorrow in serious detail. So anyway, so you can see Powell doesn't want to make a commitment. Don't forget the pressure, though, that he's got to be sitting there watching those polls, because Trump told him in not pretty much exactly in the words of, if you raise rates between now and the election, I will fire you. If you don't, I will keep you on. He basically said, play ball or you're out of here. And he's politicized the Fed and made it so that decision is like a litmus test for whether or not he's going to keep Powell in office. So how does Powell feel about that? What's his, what's he going to do after? Is he ready to retire at this point? And a board, of course, he could think that Kamala's going to win, and that you don't have to deal with Trump. So it's tough. But that's a huge factor in this decision making. It's not just that. And by the way, I'm sure Trump has put pressure on the other Fed governors as well, because you wouldn't just, you wouldn't make a big open statement to Powell to threaten him without covering your bases and going after the rest of the committee, because he can't do it by himself. The whole committee has to be. So I'm sure all of them have had whisperings in their ears saying that you don't want to make too early of a cut, and they're saying data dependent. So unless the data is strongly, strongly suggesting that a cut needs to be made, I don't think there's going to be a cut in September, and I don't think the markets are going to like that. So we'll see. But meanwhile, they seem pretty happy, right? Look at the Russell. The Russell is loving it. Things are popping. People, we're at the highs for the day right now. Then the NASDAQ is now up 622 points, 3.28%. But again, that's because the spin from the Wall Street Journal is not what we witnessed when we looked at the statement and when we heard Powell's remarks. That's what the weird problem of the whole thing is, that you've got not you, the Wall Street Journal, WSJ. When you have these guys spinning what was actually said. Federal Reserve, that's their headline in the Wall Street Journal. Federal Reserve clears path for September rate cut. That is absolutely not what we saw, was it? That's the spin of the financial media. What does Bloomberg have to say? See, there's a lot of moving parts. Powell says rate cut could happen as soon as next meeting. Well, yeah, he also said it could not happen. Rate cut could be on the table. They decide to take that statement and run with it as their headline, which gives the reader the impression that that was the gist of the conversation. That was not the gist of the conversation. Stocks rally as Powell fuels bets on September cut. Market wraps. We're not even done with it. It's 3 o'clock. They're wrapping up the market already. I'm telling you, man, it's like it's such a rigged game. It's kind of funny. Oh, what does the New York Times say? Who the New York Times says? NewYorkTimes.com. Silly New York Times. They're worried about Hamas. People ask me why I read the Times. I'm like, yeah, because they know what's important. Like strikes against Hamas and Hezbollah leaders, strikes in Iran, blah, 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 risk escalation. They're concerned about the war. There we go. Fed hints that rate cuts could come soon. See, they're doing it too, though. Same thing. Trump questions Harris's racial identity to Black journalists at a conference. Oh my God. Wow. It's my job is fun, I gotta tell you. Holy cow. All right, anyway, so it is what it is. The spin is what it is. Somebody had a question, I think Bernie had a question on, he asked about CrowdStrike. Let's take a quick look at CrowdStrike just to make sure we get to everybody. Now, CrowdStrike is being sued by Delta, the first of many thousands of lawsuits that they could get. And boy, they dropped to 230 already. This is very reactionary. It's like we knew there were going to be lawsuits. We knew there were going to be damages. We don't know what the level of their insurance is. We don't know what their contracts say. We don't know what would be decided in court. But there's going to be more than one lawsuit, and we'll see what kind of panic there is in the stock. We sold puts against these guys, so hopefully it doesn't go too much lower than this, because that'll be annoying. But I think it's just becoming, I just think you're being offered a perfectly good stock at a very low price. But it does very much depend on what their contract says. And we can talk about that next time. In fact, yes, remind me next week and we can talk more about that. This time, I want to make sure the webinar doesn't break. So they break if I go over 2 hours sometimes. So that's all for now. Thank you everybody for coming, and we will do this again next week under hopefully calmer circumstances. We'll see what happens. All right, take care everybody.